Section 3 Bitcoin's future carbon emissions. Summary. Bitcoin's electricity consumption is driven primarily by the total revenue pool available to miners and their electricity costs. Under a wide range of price scenarios, Bitcoin's electricity consumption increases and peaks within the next decade, then declines with each halving of the block subsidy. Bitcoin's electricity consumption will increase significantly within the next decade if the price of Bitcoin continues to rise. However, even under our high-price scenario, where Bitcoin's electricity consumption peaks at 11 times its 2020 level, it will only account for 0.4% of global primary energy consumption and 2% of global electricity generation. Bitcoin's future carbon emissions have been estimated using values for the future carbon intensity of grids and a baseline geographic distribution of hash rate. In all price scenarios, Bitcoin's carbon emissions increase and peak within the next decade, before declining substantially due to grid decarbonization. Bitcoin's carbon emissions will always be a small proportion of global emissions. Even at the peak of the high-price scenario, Bitcoin's emissions will only account for 0.9% of global carbon emissions. Bitcoin miners can reduce emissions in the short and medium term by buying carbon offsets, procuring renewable energy, favoring locations with renewable energy, and using wasted energy. Some companies are already leveraging these. In the long term, Bitcoin miners can benefit from grid decarbonization and likely advances in battery storage technology and the resulting lower storage costs. 3.1 How will Bitcoin's electricity consumption evolve under different scenarios? Bitcoin's electricity consumption is driven primarily by the total revenue pool available to miners and their electricity costs. Under a wide range of price scenarios, Bitcoin's electricity consumption increases and peaks within the next decade, then declines with each halving of the block subsidy. Bitcoin's electricity consumption will increase significantly within the next decade, if the price of Bitcoin continues to rise. However, even under our high-price scenario, where Bitcoin's electricity consumption peaks at 11 times the 2020 level, it will only account for 0.4% of global primary energy consumption and 2% of global electricity generation. Methodology. Two primary variables will drive Bitcoin's future electricity consumption: the total revenue pool available to miners and the absolute cost of electricity. A higher revenue pool will lead to greater participation in mining, thereby increasing the hash rate and the amount of electricity needed to mine a block. After analyzing miners' cost structures, we estimate that approximately 50% of the total revenue pool is spent by miners on electricity as a long-term average. Based on studies by NYDIG economist and the Cambridge Center for Alternative Finance, we assume that miners' average cost of electricity was 5 cents per kilowatt-hour in 2020 and that this cost increases at 1% a year in nominal terms. This electricity expenditure is then converted into total electricity consumption. Box 5. Bitcoin miner cost structure. Bitcoin miners' costs are predominantly those of their machines and the electricity to run them. Spending on electricity varies as a proportion of their revenue depending on the increasing efficiency of the machines and the volatility of Bitcoin's price. We estimate that miners' electricity costs average approximately 50% of their revenues. This is derived from long-run averages at both the network and machine class level. For the network, we analyze the proportion of miner revenue spent on electricity over different periods and under different criteria. We also calculated the proportion of revenue spent on electricity for specific machine classes, namely the Antminer S9s and S19s, and took the average proportion over the lifespan of each machine class. We then validated our results through miner interviews and compared them with external reports from NYDIG Economist and the Cambridge Center for Alternative Finance. For comparison, NYDIG Economist estimates electricity costs at 70% of total miner revenue, but we think this is likely an overestimate due to its understating of miners' expenditure on equipment. Cambridge estimates miner electricity costs at 43% of revenue, closer to our estimate. In July 2021, the electricity costs of Bitcoin miners were very low compared to the long-term average of 50%. They spent only around 20% of their revenue on electricity. The threefold rise in the Bitcoin price from 2020 increased mining revenue rapidly, but the supply chain takes longer to react with new mining machines and locations. Furthermore, the Chinese crackdown then reduced the number of miners and the associated hash rate. This reduced competition has, via the difficulty protocol, resulted in a lower number of terahashes required to create a new block and a large reduction in electricity demand. It will take time for the market to return to a new equilibrium level of hash and for miners to increase their electricity consumption to the point at which its cost is 50% of their revenues. There is currently a worldwide chip shortage, and there can be significant lead times for setting up new mining locations because of the need for things such as grid connection approvals and transformer purchases. These logistical factors will slow the recovery in hash rate and therefore boost the profits of existing non-Chinese miners in the interim. This slowdown could potentially continue until the next halving in early 2024, when the reduction in block subsidy will automatically lower mining profitability and, with it, the hash rate. For simplicity, we have modeled a linear return to the long-term average of spending 50% of revenue on electricity by 2024, as the market works through the disruption of the Chinese exodus and the threefold increase in price since 2020. The total revenue pool available to miners consists of two streams. The block subsidy, which consists of newly issued bitcoins, and transaction fees that parties carrying out Bitcoin transactions pay as an incentive to miners to include their transaction in the next block. Of these two parameters, the block subsidy is the most stable and easiest to predict. By design, the reward halves every 4 years, and it will continue to do so until all 21 million bitcoins have been mined, estimated to be around 2,140. Historically, transactions are roughly 5%, or about 60 bitcoins, a day. However, during the first quarter of 2021, average transaction fees increased to around 150 bitcoins a day, and transaction fees have previously exceeded 800 bitcoins a day. It is uncertain how transaction fees will evolve, as they are driven by the volume of transactions and users' willingness to pay. For this analysis, we have projected electricity consumption based on an assumption of 150 bitcoins a day. As transaction fees and block subsidies are themselves denominated in Bitcoin, their value to miners is intrinsically linked to the Bitcoin price. This is the most volatile factor in the value of the revenue pool and, therefore, in Bitcoin's electricity consumption. The price of Bitcoin depends exclusively on societal demand, as its supply is fixed by the protocol. It is not the role of this report to predict the future price of Bitcoin, so we have instead projected electricity consumption to 2040 under 4 price scenarios. The range of these scenarios is wide, given Bitcoin's immaturity and high price volatility to date. High price assumes that Bitcoin will equal gold's historical average value as a store of global wealth. Bitcoin's market value would rise to a nominal value of $10 trillion in 2030, implying a price of around $490,000 per Bitcoin. Between 2030 and 2040, Bitcoin's price would continue to grow at a slower rate of 2% per year, rising to $595,000 in 2040. Medium price assumes that Bitcoin will equal half the historical average value of gold as a store of global wealth. Bitcoin's market value would reach a nominal value of $5 trillion in 2030, implying a price of around $245,000 per Bitcoin. Between 2030 and 2040, Bitcoin's price would continue to grow at a slower rate of 2% per year, rising to $300,000 in 2040. Base price assumes the price would grow at a rate of 2% per year from the February 2021 average of approximately $50,000, rising to around $60,000 in 2030 and $75,000 in 2040. Low price assumes that the Bitcoin price would decline to $10,000 in 2030, which is in line with the 2020 average. Between 2030 and 2040, Bitcoin's price would grow at a rate of 2% per year, rising to $12,000 in 2040. After 2030, under all price scenarios, we assume Bitcoin will mature, and its price will stabilize, that is, growth will be slower and volatility will decline. Box 6. Comparison of Bitcoin to gold. How valuable might Bitcoin become? Money has taken various forms throughout history, from shells to gold to fiat currencies, and it serves three primary functions: a store of value, a medium of exchange, and a unit of account. A store of value refers to the ability of money to retain its value over time. For money to act as a strong store of value, there should be a finite supply and some mechanism that restricts the production of new units, to ensure that the value of existing units is maintained. Bitcoin's supply and production of new units is pre-programmed into its protocol. Its supply will increase to a predetermined limit of 21 million bitcoins, and bitcoins are added to the supply at a fixed rate of 1 block every 10 minutes, with the number of bitcoins released in each block having approximately every 4 years. Since one of Bitcoin's primary use cases is as a store of value, and gold is a strong store of value, we have anchored our medium and high price scenarios around estimates for the future value of gold. Since 1910, the value of the world's gold has averaged around 8% of annual global GDP. Global GDP is likely to reach $135 trillion in nominal terms by 2030, implying a nominal value of gold of around $10 trillion. Our high-price scenario for Bitcoin assumes that it would equal gold's value as a store of global wealth and reach a total market value of $10 trillion in 2030. The medium price scenario assumes that Bitcoin would equal half the value of gold as a store of global wealth, reaching a total value of $5 trillion in 2030. Although we have used the value of gold to define our scenarios, there is no reason why Bitcoin cannot become more valuable than gold in the future. Results. Chart 20 shows projections of Bitcoin's electricity consumption for each price scenario. Under all price scenarios, Bitcoin's electricity consumption increases and peaks within the next decade, then declines with each halving of the block subsidy. The halving of the block subsidy causes significant troughs in our projections every 4 years, as it decreases the revenue pool available to Bitcoin miners, a decline which is not fully offset by either transaction fees or Bitcoin price appreciation. In the low price scenario, electricity consumption rises to a peak in 2024, as miners relocate and restart their operations following the exodus from China. After this peak, electricity consumption declines rapidly, falling below 2020 levels by 2026. In the base, medium and high price scenarios, electricity consumption rises to a peak in 2027, after which it declines rapidly. Bitcoin's electricity consumption will increase significantly in the next decade if its price continues to rise. An increase in price would encourage more miners to compete to solve the mathematical problems, resulting in an increase in hash rate and, therefore, electricity consumption. This is shown in the medium and high price scenarios, where electricity consumption peaks at 6 and 11 times the 2020 level, respectively. Although Bitcoin's electricity consumption is projected to increase in the next decade under all price scenarios, it will remain a small proportion of global primary energy consumption and electricity generation. Even under the high price scenario, where Bitcoin's electricity consumption peaks at 706 terawatt-hours, it will still only account for 0.4% of global primary energy consumption and 2% of electricity generation. By 2040, its proportion of global primary energy consumption will decrease to 0.2%, and its proportion of electricity generation will fall to 0.8%. 3.2 How will Bitcoin's carbon emissions evolve under these scenarios? Bitcoin's future carbon emissions have been estimated using values for the future carbon intensity of grids and a baseline geographic distribution of hash rate. Under all price scenarios, Bitcoin's carbon emissions increase and peak within the next decade, before declining substantially due to grid decarbonization. Bitcoin's carbon emissions will always be a small proportion of global emissions. Even at the peak of the high price scenario, Bitcoin's emissions will only account for 0.9% of the global total. Regardless, there is an opportunity for Bitcoin miners to set their carbon emissions on a path to net zero. Methodology. The Chinese ban on mining has further complicated the assessment of Bitcoin's future carbon emissions. In the short term, the exodus from China has roughly halved both electricity consumption and annualized carbon emissions, which declined from 49 million tons of carbon dioxide in March 2021 to 27 million tons of carbon dioxide in July. For at least 12 months and likely longer, it will not be clear which countries will replace China as future mining locations. However, an understanding of locations will be necessary to assess the carbon intensity of future Bitcoin mining. We can expect miners to target those markets where electricity is low in price, new rigs can be connected relatively quickly, and where the political climate is supportive of Bitcoin. Attractive countries for Bitcoin mining are illustrated in Chart 22, and they include both low and high carbon intensity grids. High carbon markets are defined as those with an average on-grid carbon intensity of above 500 gCO2 per kilowatt-hour, and low carbon markets are defined as those with an average on-grid carbon intensity of below 500 gCO2 per kilowatt-hour. Markets above this threshold are heavily reliant on coal, as natural gas, the next most carbon-intensive fuel, has an average intensity of only around 400 gCO2 per kilowatt-hour. We categorize these attractive countries as low or high carbon markets, based on the average carbon intensity of their grids. We then estimated the likely distribution of mining hash rate between low and high carbon markets using three assumptions. Historical distribution. We assumed that the historical hash rate in China is redistributed across the other countries where miners were already located. Electricity generation. We assumed that the hash rate is distributed across the attractive countries, weighted by each country's total electricity generation, i.e. the same proportion of a country's electricity production goes to Bitcoin in each country. Electricity price. We assumed that the hash rate is distributed first to the cheapest country until a cap is reached, reflecting the fact that markets do not have unlimited supply of cheap electricity that can be added. This cap is set at a proportion of each country's total generation, with the maximum based on the highest penetration of miners seen to date, which is in Kazakhstan. The results of these different assumptions are shown in Chart 23. From this, we estimated a baseline emissions distribution of 60 to 40 between low and high carbon markets, with an upper bound sensitivity of 40 to 60 and a lower bound sensitivity of 80 to 20. To project the average carbon intensity of each market's grid, we use the 2020 IEA Sustainable Development Scenario, which provides values for grid carbon intensity at a regional level up to 2040. Chart 24 shows the aggregated IEA projections for the low and high carbon markets we have defined. Over time, carbon intensity in high carbon markets falls more rapidly than in low carbon markets, as low-cost solar and wind displace coal. We assumed that our baseline distribution with a 60-40 split between low and high carbon markets remains constant throughout our projections. Regulatory or price developments may shift future distributions, but we have not reflected these possibilities in our projections. Results: in the low and base price scenarios, carbon emissions rise to 33 and 47 million tons of carbon dioxide in 2024, as electricity consumption increases along with the market's recovery from the exodus from China. After the 2028 halving of the block subsidy, carbon emissions fall quickly below the net zero pathway, which represents a linear reduction in carbon emissions from 2020 levels to zero by 2050. In the medium and high price scenarios, carbon emissions rise to a peak in 2027, then decline substantially due to the decarbonization of the grid and the halving. In these scenarios, Bitcoin's carbon emissions increase significantly before their peaks. In the medium price scenario, emissions reach a peak of 123 million tons of carbon dioxide, 4 times the 2020 level. In the high price scenario, emissions peak at 234 million tons of carbon dioxide, 7 times the 2020 level. Even at the peak of the high price scenario, Bitcoin's emissions will only account for 0.9% of global carbon emissions in 2027. By 2040, carbon emissions in the high price scenario will already have returned to pre-2020 levels, at 22 million tons of carbon dioxide, just 0.1% of global emissions. If Bitcoin's level of adoption and price are low, its emissions will be low. If Bitcoin's adoption and price are high, because it delivers societal value as a form of sound money, its emissions will be higher, but still small on a global level. Bitcoin's future price is the most sensitive parameter for future projections of its associated carbon emissions, which is why we have presented results for 4 price scenarios. For other parameters, we have tested the sensitivity or our results to our assumptions. Table 3 summarizes our estimates of the input ranges, and the impact of these on our 2030 carbon emissions calculation. These ranges, at less than plus 30%, are all modest when compared to the price uncertainty. 3.3 What decarbonization levers could reduce emissions? Bitcoin miners can reduce emissions in the short and medium term by buying carbon offsets, procuring renewable energy, favoring locations with renewable energy, and using wasted energy. Some companies are already leveraging these. In the long term, Bitcoin miners can benefit from grid decarbonization and likely advances in battery storage technology, and the resulting lower storage costs. There are several decarbonization levers available to Bitcoin miners. To reduce emissions in the short term, they can buy carbon offsets and procure renewable energy from existing sources through the grid. In the medium term, they can favor locations with renewable energy and use wasted energy, such as curtailed hydroelectric energy and flared gas. In the long term, they can benefit from grid decarbonization, as well as likely advances in battery storage technology and lower storage costs, which could solve off-grid renewables' problem of intermittency. Bitcoin miners are already starting to reduce emissions using these levers, and some companies have recently become carbon neutral. This has predominantly been achieved by locating in regions with a low carbon intensity and by purchasing carbon offsets. As environmental concerns regarding carbon emissions persist, more miners will likely take such actions. Buy carbon offsets. Bitcoin miners can purchase carbon offsets to neutralize their emissions. A carbon offset for an operation funds an activity that results in a reduction of carbon dioxide elsewhere, such as tree planting or carbon sequestration. As the quality of carbon offsets varies, best practices ensure that offsets fulfill certain conditions. Additional, they reduce carbon emissions or remove carbon that would not be reduced through other incentives. Permanent, they reduce emissions or remove carbon permanently. Without leakage, gains from a given project do not result in an increase in emissions elsewhere. Independently verified, a third party audits the offsets to confirm that the carbon reductions are real and credible. Box 7. Climate Vault. Several companies provide carbon offsets, including Climate Vault, a non-profit organization founded at the University of Chicago that has a relatively new and innovative solution. Rather than trying to estimate the carbon reductions from planting trees, Climate Vault measures the exact quantity of carbon emissions that an offset prevents. Climate Vault achieves this by purchasing carbon emissions allowances on cap and trade compliance markets and vaulting them so that emitters can't use them. In a cap and trade system, a government sets a cap on the total carbon emissions for a given industry or for the whole economy. Within the cap, regulated entities buy or receive emissions allowances, which they can trade as needed. Each year, regulated entities must surrender enough allowances to cover their carbon emissions. Otherwise, they are penalized for violating the system. The compliance market refers to the market through which these regulated entities buy and sell carbon emissions allowances. By purchasing emissions allowances from the compliance market and not selling them back, thereby vaulting them away, Climate Vault decreases the total possible emissions from entities regulated by the cap and trade system. Procure renewable energy. Activities with high electricity consumption, such as certain data centers, can procure electricity that has been generated 100% from renewables. This is generally not achievable by relying on the local electricity grid mix. Bitcoin miners can buy such electricity too, in 3 ways that are simple, effective, and globally recognized. One way is to buy renewable energy certificates, which prove that a miner has purchased energy generated from renewables. These certificates are relatively cheap, averaging at around $1 per megawatt-hour, just 2% of miners' average electricity cost of $50 per megawatt-hour, and they are available in most countries. If all Bitcoin miners purchased renewable energy certificates to cover their total demand, it would cost them a total of around $60 million, or about 1% of 2020 mining revenues. Leading companies around the world are using renewable energy certificates as a first step to delivering their goal of sourcing 100% of their electricity from renewable sources. RE100, for example, groups leading corporations that are committed to 100% renewable energy, and it accepts certificates as a key lever. A second option for a Bitcoin miner is to enter a contract with a local electricity supplier that procures renewable energy on their behalf. These contracts usually take the form of green tariff programs, in which the electricity supplier procures renewable energy at a small premium to its regular contracts. However, this kind of contract is not available in all countries. Third, Bitcoin miners can enter short-term power purchase agreements with renewable energy generators. A PPA details conditions such as the amount of electricity a generator will supply, as well as the price and contract length. These agreements usually involve the purchase of both physical electricity and renewable energy certificates. Favor locations with renewable energy. Bitcoin can be mined anywhere in the world, provided there is access to a reliable, low-cost supply of electricity and a basic internet connection. This gives Bitcoin miners, unlike actors in many other industries, the option of favoring locations that have a high proportion of renewable electricity in their grid mix. The 5 main factors cited by miners for choosing a mining location are the electricity price, the regulatory environment, infrastructure availability, access to mining machines, and capital costs. Miners can add a 6th factor of access to renewable energy, for example through a high proportion of renewables in the electricity grid mix. The exodus of mining from China provides the industry with an opportunity to deliver a step change in emissions if those miners relocate to low-carbon intensity regions. Use waste energy. The use of energy that would otherwise be wasted represents another opportunity to reduce emissions. This waste energy can come in various forms, such as curtailed hydroelectric energy or flared gas. Curtailed hydroelectric energy. One option is to move to locations with excess hydroelectric energy. China has a significant amount, estimated to be around 30 terawatt-hours in 2020. Although miners previously located in China to take advantage of this energy during the wet season, China is not a viable option for the future due to the crackdown on mining. In addition, miners located in China resorted to the use of coal-generated electricity in the dry season. Bitcoin miners have also started to use Russia's curtailed hydroelectric energy. One firm, which operates data centers that offer co-location services for cryptocurrency mining, uses surplus hydroelectric energy from the Bratsk region. However, the opportunity is small. Even Russia's largest hydroelectric power plant, Sayano-Sheshenskaya, only curtails up to 2 terawatt-hours of its electricity in a year with higher than average rainfall. That amounts to just 3% of Bitcoin's electricity consumption in 2020. Evidence of curtailed hydroelectric energy in other markets is also limited, so this opportunity is small in scale. Shifting to locations with curtailed renewable energy is only effective for hydroenergy. Solar and wind curtailment tend to occur for only short periods of time, a few sunny hours in the middle of the day or periods of high wind. Flared gas. Another possibility is to use gas that would otherwise be flared. Flaring is the controlled burning of gas, mainly methane, given off as a by-product of oil production. Gas is flared when there is no use for it, such as on-site use or outside sale. Flaring is typically carried out in oil fields in remote locations, where export pipelines are limited, and when it is not economical to re-inject the gas into the oil reservoir to increase oil production. Flaring wastes energy and emits carbon dioxide. However, the gas can be converted into electricity using relatively cheap, small-scale turbines on site, which avoid the need for expensive export pipelines or a grid connection. Bitcoin mining is an ideal use for this electricity because of its flexibility of location. The gas would likely be available at low cost to Bitcoin miners, as it would otherwise be wasted. Projects of this kind have short payback periods and are therefore aligned with Bitcoin mining's investment horizons of 3 to 5 years. Moreover, burning gas in a turbine is much more efficient than burning it through a flare, so more of the methane is burned and less is emitted into the atmosphere. One company leveraging this opportunity is Crusoe Energy, which aims by the end of 2021 to utilize up to 0.3 million cubic meters of flared gas a day on Bitcoin mining. Since this gas would otherwise have been flared, using it to generate electricity to mine Bitcoin represents a productive use of an otherwise wasted energy resource. It results in no incremental increase in greenhouse gas emissions, and possibly a decrease due to a reduction in escaped methane. In 2020, some 142 BCM cubic meters of gas was flared worldwide, sufficient to produce around 430 terawatt-hours of electricity. If we exclude offshore and more challenging markets, such as Iraq, there remains around 140 terawatt-hours of opportunity. Due to the geography, independence of Bitcoin mining and the abundant quantities of wasted, curtailed, or inefficiently used energy resources worldwide, miners are increasingly selecting from a wide palette of technologies to procure inexpensive energy, while they are also decarbonizing. Some miners have adopted a strategy of combining highly renewable sources of energy with offset procurement. For example, one converted a coal plant to a natural gas plant with lower carbon intensity and also committed to offset all its residual emissions. A large U.S. hosting service provider disclosed its energy mix and committed to 100% net, carbon, neutral operations through offsets. Other miners select their locations to procure renewable energy. Some large ones in Ontario and British Columbia use nearly 100% hydropower. Lastly, a number of mining firms are already taking advantage of electricity generated from waste gas. We expect these various carbon mitigation strategies, and others, to be increasingly utilized in the coming years. Box 8. Crusoe Energy Gas Flaring Business Model. Crusoe Energy operates 40 gas-powered data centers across the United States and offers hosting services to energy-intensive industries. Bitcoin mining represents up to 80% of Crusoe's computing capacity. Crusoe Energy procures low-cost gas that would otherwise have been flared from oil and gas producers and installing a piping system to transport it to modular 2 megawatts electricity generators. The electricity is then consumed by Bitcoin mining machines. Crusoe Energy deploys its systems directly to the flare sites, reducing the cost of gas transport and electricity transmission. The company charges Bitcoin miners for their electricity consumption and also mines Bitcoin with its own machines. The company claims that, relative to unmitigated flaring, the use of waste gas for energy reduces carbon equivalent emissions by up to 63%, as burning the gas in the generators is more efficient at burning the gas and less methane is emitted to the atmosphere. Conclusion. In this paper, we have estimated the current and historical energy outlays for Bitcoin mining and the resulting carbon emissions. We have also suggested potential future emissions pathways. The current energy consumption of Bitcoin miners can be inferred relatively easily, but projecting Bitcoin's future emissions intensity requires various assumptions. These relate to Bitcoin's price trajectory, miners' energy mixes and geographies, miners' economics, the off-grid share of mining activity, the average price of electricity available to miners, and the volume of transaction fees. However, even in our most aggressive, high-price scenario, in which Bitcoin reaches $10 trillion by 2030, its emissions amount to only 0.9% of the world's total, and its energy outlay is just 0.4% of the global total. These figures were calculated without consideration of the observable acceleration in the use of offsets, renewable energy certificates, and waste energy. Bitcoin mining may also have material ancillary benefits. Because Bitcoin mining represents a highly interruptible load, Miners can turn off their machines at short notice during peak times and create slack that other grid consumers can benefit from. As grids come to incorporate more solar and wind power, Bitcoin miners can help smooth out the erratic supply of wind and solar energy. Indeed, miners in certain grids have begun opting into demand response programs. Further, given that Bitcoin mining is highly portable and modularizable and functions anywhere on Earth due to the ubiquity of satellite internet, it can help to monetize novel energy assets even before these are fully integrated to the grid. As buyers of first resort, Bitcoin miners have the potential to improve the economics of new renewables projects by providing a flexible and immediate offtake. Overall, the prospects for the decarbonization of Bitcoin mining over the coming decades are quite promising. Meanwhile, against a backdrop of increasing financial surveillance and global monetary instability, the case for Bitcoin as a monetary safe haven and neutral settlement network grows ever stronger.